Hey everyone, welcome back. We're going deep today, a deep dive into what Warren Buffett might be signaling to the rest of us.
Oh, yeah.
You know, Oracle of Omaha and all that. We've got this article, pretty interesting look at what he's been doing lately.
It's definitely got people talking.
For sure. I mean, he hasn't come right out and said, hey, market's going to tank or anything, but...
But there are definitely some signs. Maybe he's a little cautious.
Cautious is putting it mildly. 8 quarters in a row now. He's been a net seller of stocks. Doesn't exactly scream confidence, does it?
Not exactly.
And then there's the big one, right?
Yeah.
The elephant in the room. How much cash is Berkshire Hathaway sitting on right now?
I think it's, what, over $300 billion?
Try $325 billion.
Yeah.
Biggest cash pile in the company's history. It's like he's battening down the hatches while everyone else is, still partying.
It does make you wonder, doesn't it? Especially when you think about how Buffett's always said that whole be fearful when others are greedy thing.
Right. Greedy when others are fearful. And right now, a lot of people are feeling pretty greedy, wouldn't you say? Market's near all-time highs and all.
Yeah, there's definitely a lot of exuberance, shall we say. It does make you wonder if things are getting a little, well, frothy.
You know what else caught my eye in this article? They talk about the, the Buffett indicator?
Oh, yeah, that's an interesting one.
Basically, the ratio of the total value of the U.S. stock market compared to the U.S. GDP, right?
That's right. And Buffett himself has said, or at least it's been reported, that when that ratio gets close to 200%, that's when you got to start worrying.
200%.
Well, guess what? Right now, that indicator is hovering right around there. And historically speaking, that level has preceded some, shall we say, significant market corrections.
Like in 2008?
Yeah.
Okay, I got to ask, how is this Buffett indicator calculated? What makes it so important?
It's actually pretty simple conceptually. Take the total market cap of all the publicly traded U.S. companies divided by the U.S. GDP. Think of it like this. If that indicator is at 100%, it basically means the stock market is, reasonably valued compared to the economy. But at 200%, you're paying double for the same underlying value. That's when the alarm bells should maybe start ringing a little bit.
Got it. So is it time to hit the panic button? Sell everything?
Mm-hmm.
Or is there a more nuanced way to look at this?
I'd say panic is never a good investment strategy. Remember, even Warren Buffett, the oracle himself, he can't predict the future perfectly. But this indicator, along with his own actions, it's definitely sending a signal, maybe a time to be a little more cautious.
Yeah, I remember back in 2008 when things went south, I totally panicked. Sold everything.
Looking back, I wish I'd understood that whole be greedy when others are fearful idea a bit better.
Hindsight is always 20/20.
Right. But, some people argue this time it's different. Interest rates are low, tech is booming. Maybe these high valuations are justified.
That's a fair point. Those are definitely factors.
Yep.
But you also got to remember, markets are cyclical. What goes up must come down.
Exactly. It's not a question of if there'll be a correction. It's when and how bad.
So if we're trying to play by Buffett's rules here, what are some concrete steps, actionable stuff that our listeners can do right now?
Well, that's where things get really interesting.
Okay, so we've got this potential warning sign, Buffett loading up on cash, that Buffett indicator flashing. What can people actually do, like right now?
Well, one thing Buffett focuses on, instead of trying to time the market, which is almost impossible.
Oh, yeah. Good luck with that.
Right. He picks strong companies, solid fundamentals, thinking long term.
Okay, so quality over quantity. But with the market this high, isn't everything overpriced? How do you even find those gems?
You got to dig a little deeper, look past the hype, all the trends. Don't just chase the hot stock tip. You got to understand the business itself.
So like what? Dive into their financials.
Exactly. Look at their financials, yeah. But also their competition. What's their long-term strategy? Ask yourself, is this a company I'd be happy to own for the next 10 years, 20 years?
I like that. Focusing on the companies you really believe in. Long haul. It's so easy to get distracted by, the daily ups and downs.
Right, and that's where having cash on hand comes in. It's not just about playing it safe. It's about being ready.
Ready for what?
For when those opportunities pop up. When the market corrects, and it always does, you want to be ready to buy while everyone else is panicking.
You can be greedy when others are fearful. That's pretty smart.
It is. Being prepared, patient, ready to, pounce when the market throws you a curveball.
Okay, that makes sense. But what about the stocks we already own? Should we be reevaluating our portfolios now because of this warning sign?
That's a great question. And there's no one-size-fits-all answer. It depends, right? Your situation, all that.
Sure.
But you got to remember, Buffett, he's not afraid to trim his positions. Sometimes even sell something entirely if he thinks things have changed.
Even if he likes the company.
Even if he likes it, yeah. If the fundamentals aren't there anymore or the risks outweigh the rewards, he's out of there.
So sometimes you got to let go, even if you love them. Man, that could be tough, especially when you've gotten emotionally attached to a stock.
Oh, absolutely. Investing, it's got to be about clear-headed decisions, facts and analysis, not emotions. And it's a constant process, reevaluating.
So we should always be checking in on our portfolio.
Yeah. Make sure your investments still line up with your goals, your risk tolerance, all that. Sometimes that means making tough choices.
Like breaking up with a company you really like.
Sometimes, yeah. It's about being proactive, not waiting for the market to force your hand. Stay informed, engaged, This is about building wealth over time, not overnight.
That's a good point. And you know what else is interesting? Buffett, he's not just buying stocks these days. This article mentions he's putting a lot of money into other stuff. Real estate, energy.
That's right, diversification, another key part of his strategy.
Don't put all your eggs in one basket, right?
Exactly. Spread your investments around, reduce your risk, and you can take advantage of different opportunities, different sectors.
So while we're being cautious with stocks, it might also be a good time to look at other options.
It's worth considering, for sure. Real estate, for example, can be a good hedge against inflation, and it can provide some steady cash flow. And then there's energy, renewable energy especially. Huge demand right now, could be some real opportunities there.
So it's not just about finding the right stocks, it's about the right mix of everything in your portfolio.
Exactly. And that mix, it's going to be different for everyone, right? Depends on your situation, your goals, your risk tolerance. No one-size-fits-all solution.
Man, this has been so helpful. I'm really getting a sense of how Buffett thinks. But before we wrap up, there's one question I keep coming back to. We've talked a lot about being cautious. But is there a point where too much caution can actually hurt you? I mean, you miss all the shots you don't take, right? But in investing, those missed shots can be pretty expensive.
Yeah, that's a tough one. How do you balance being cautious but not missing out on good opportunities? It's something every investor struggles with, really. No easy answers there.
So much depends on you personally, right? How much risk you're comfortable with, your goals, how long you're planning to invest.
Exactly. But, if you look at Buffett, he's cautious, but he's also decisive. When he sees something he likes, he's not afraid to go big. But he always does his research first. Make sure the odds are in his favor. It's about calculated risk, not just, throwing darts at a board.
So it's not about being reckless. It's about understanding the risks
Mm-hmm.
and not letting fear stop you from acting if you've done your homework.
Exactly. Sometimes the best opportunities come with a little bit of risk. But it's got to be calculated risk. You got to know what you're getting into.
Sounds like it's not really about being too cautious, as long as it doesn't stop you from jumping on those chances when they come along.
That's a great way to put it. It's about that sweet spot, right? Protecting your money, but also letting it grow. And that sweet spot's going to be a little different for everybody.
This has been fantastic. We've covered so much. Buffett's warning signs, the Buffett indicator, even the psychology of investing, fear and greed, all that. As we wrap up here, what are some key things you hope our listeners will remember as they navigate this market,
I think the biggest thing is knowledge is power. The more you know about the market, about specific companies, about what you want to achieve as an investor, the better decisions you'll make. Don't just follow the herd or go with your gut. Do your research. Stay curious. Keep learning.
Well said. Investing, it's more than just numbers and charts. It's about strategy, your own psychology, making choices that fit with your goals and values. We hope you'll keep digging into these ideas. Maybe research how that Buffett indicator has performed historically. Or look into companies that fit the approach we talked about today. The more you know, the more confident you'll feel.
And even though we've talked a lot about caution today, don't let that stop you from investing altogether. It's still one of the best ways to build wealth over time. With the right knowledge and the right mindset, you can achieve your goals.
Thanks for joining us on this deep dive, everyone. We hope you found it helpful. Remember, stay informed, stay engaged, and keep on learning.